Stock technical analysis is a method of evaluating securities by analyzing historical price data and trading volume to identify patterns and trends that can help predict future price movements. Technical analysts, also known as chartists, believe that all relevant information about a stock is reflected in its price and that historical price movements tend to follow certain patterns that can be identified and used to make informed trading decisions. Technical analysis is often contrasted with fundamental analysis, which instead evaluates a company's financial health and intrinsic value by examining factors such as earnings, revenue, and industry trends. The underlying principle of technical analysis is that the market is driven by supply and demand forces, which are influenced by the emotions of fear and greed. When many investors are bullish about a stock, they tend to buy more, driving up the price. Conversely, when many investors are bearish, they tend to sell, causing the price to fall. Technical analysts aim to identify patterns and trends in the market that can help them anticipate these emotional shifts and make more informed trading decisions. There are several key concepts and tools that technical analysts use to evaluate stocks and identify trading opportunities. One of the concepts is chart patterns, which is covered as an intro in this video. Briefly, chart patterns are specific formations that appear on price charts, which can help technical analysts predict future price movements. They can be classified into two main categories: reversal patterns and continuation patterns. Specifically, this video covers bullish pattern formations that can signal the potential for a price increase or a continuation of an existing uptrend. Bullish pattern formations can be identified as reversal, continuation, or a hybrid of both patterns. It is important to note that these patterns are not guaranteed to result in the expected outcomes. Technical analysts should use them in conjunction with other technical analysis tools and indicators to increase the likelihood of accurate predictions. This video is brought to you by TickerDD. See our other videos for ticker-specific observational analysis. Capitalist brothers and sisters, come stonk with us. The V-shaped reversal is a bullish chart pattern in technical analysis that signals a potential reversal of a downtrend. It is characterized by a sharp and sudden reversal in price that forms the shape of a V on a price chart. Here's a simple explanation of its components. Downtrend. The V-shaped reversal pattern forms during an existing downtrend when the price experiences a prolonged decline over time. Bottom formation. The pattern is characterized by a sharp and sudden reversal in price, forming a V shape. The bottom of the V should be well defined and the price should move higher after the reversal. Volume. The volume during the reversal should be higher than average, indicating increased buying pressure. Breakout. The breakout occurs when the price moves above the resistance level formed by the top of the V. This breakout signals the bullish reversal and serves as the entry point for traders. To trade a V-shaped reversal pattern, traders typically wait for the breakout above the resistance level. They may enter a long position when the price breaks above this level, with a stop-loss order placed below the lowest point of the V to manage risk. The price target for the trade is often calculated by projecting the distance between the lowest point of the V and the resistance level upward from the breakout point. The V-shaped reversal has been recognized as a bullish pattern for many years. Looking back at historical price and volume, here's a real-life observation of a possible reversal V-bottom pattern. In 2009, after the global financial crisis, the U.S. stock market experienced a severe decline, with the S&P 500 index dropping by more than 50% from its peak in 2007. During this period, many stocks were trading at multi-year lows, presenting potential buying opportunities for traders who were looking for bargain prices. One such stock was Apple Inc. AAPL, which had experienced a sharp decline from its peak in 2007, dropping from a high of $200 to a low of around $80 by early 2009. However, in April of that year, the stock formed a reversal V-bottom pattern, with a sharp reversal in price followed by a sustained uptrend. The bottom of the V was well defined, and the volume during the reversal was higher than average, indicating increased buying pressure. Many traders and investors recognized the reversal V-bottom pattern in Apple stock and started to accumulate shares, betting on a potential turnaround in the company's fortunes. They were rewarded for their faith in the stock, as Apple's shares went on to soar to new highs over the coming years, driven by the success of products such as the iPhone and iPad. This is just one example of how the reversal V-bottom pattern can be used to identify potentially profitable trading opportunities. However, it's worth noting that past performance is not indicative of future results, and traders should always conduct their own research and analysis before making any trading decisions. See case study reference for more information on this AAPL use case. A well-regarded book on technical analysis that covers the reversal V-bottom, among other chart patterns, is Technical Analysis: The Complete Resource for Financial Market Technicians, by Charles D. Kirkpatrick II and Julie R. Dahlquist. This book provides a comprehensive introduction to technical analysis and offers insights into various chart patterns, indicators, and trading strategies. Reading this book can help you gain a better understanding of the reversal V-bottom and how to incorporate it into your trading strategy. A bullish flag is a chart pattern that forms during an uptrend and is considered a continuation pattern. In other words, this pattern signals a potential continuation of an existing uptrend. It typically forms during a strong upward price movement, followed by a short-term consolidation phase. The pattern is called a bullish flag because it resembles a flag on a flagpole when viewed on a price chart. The pattern typically indicates that the price is consolidating before a breakout to the upside, signaling a continuation of the prevailing bullish trend. Here's a simple explanation of its components. Flagpole. The flagpole represents a rapid and significant increase in price, indicating strong buying pressure. It is the initial steep upward movement that precedes the formation of the flag. Flag. The flag is a small, downward-sloping price consolidation that follows the flagpole. It is formed by parallel trend lines connecting the highs and lows of the consolidation period. This consolidation represents a pause or a period of profit-taking after the strong upward movement. To trade a bullish flag pattern, traders typically wait for a breakout above the upper trend line of the flag, which signals a continuation of the uptrend. They may enter a long position when the price breaks above the flag, with a stop-loss order placed below the recent low of the flag or the flagpole to manage risk. The price target for the trade is usually calculated by measuring the length of the flagpole and projecting that distance upward from the breakout point. A prominent example of a bullish flag pattern occurred during the historic bull market in the U.S. technology sector during the late 1990s. A specific instance can be observed in the chart of Microsoft Corporation, MSFT, in 1999. In early 1999, Microsoft's stock price experienced a sharp uptrend, reaching a peak in late April. The stock then began consolidating, forming a downward-sloping flag pattern over the next couple of months. The price broke out of the flag pattern in July, continuing its upward trend and eventually reaching an all-time high by the end of 1999. This bullish flag pattern is a classic example, as it demonstrates the initial surge in price, the flagpole, followed by a period of consolidation, the flag, and eventually a continuation of the upward trend after the breakout. To verify this example, you can refer to historical stock price data from sources like Yahoo Finance or Google Finance, where you can find the historical price chart for Microsoft in 1999. The case study reference link is to Yahoo Finance's historical data page for MFST for you to see this data. Remember to adjust the date range to 1999 to view the specific chart pattern mentioned in this example. A great book to learn more about the triple bottom trading pattern, along with various other chart patterns and technical analysis concepts, is Technical Analysis of the Financial Markets, by John J. Murphy. This book is widely considered a classic and a must-read for anyone interested in technical analysis and chart patterns. In this comprehensive guide, Murphy covers numerous chart patterns, including the triple bottom, as well as various technical indicators and tools. The book is well organized and easy to follow, making it an excellent resource for both beginners and experienced traders looking to expand their knowledge of technical analysis. A bullish pennant is a chart pattern in technical analysis that signals a potential continuation of an existing uptrend. It typically forms after a strong upward price movement, followed by a brief consolidation phase. The pattern is called a bullish pennant because it resembles a small triangular pennant flag on a flagpole when viewed on a price chart. The main difference between the bullish flag and the bullish pennant pattern is their shape during the consolidation phase. The bullish flag features a rectangular, slightly downward-sloping consolidation, while the bullish pennant has a symmetrical triangle-shaped consolidation. Here's a simple explanation of a bullish pennant's components. Flagpole. The flagpole represents a rapid and significant increase in price, indicating strong buying pressure. It is the initial steep upward movement that precedes the formation of the pennant. Pennant. The pennant is a small, symmetrical triangle-shaped consolidation that follows the flagpole. The price converges within the triangle, with the trend lines connecting the lower highs and higher lows gradually coming closer together. To trade a bullish pennant pattern, traders typically wait for a breakout above the upper trend line of the pennant, which signals a continuation of the uptrend. They may enter a long position when the price breaks above the pennant, with a stop-loss order placed below the recent low of the pennant to manage risk. The price target for the trade is usually calculated by measuring the length of the flagpole and projecting that distance upward from the breakout point. The bullish pennant has been recognized and studied since the early 20th century. A notable example of a bullish pennant pattern can be observed in Tesla Inc.'s TSLA stock chart in 2020. A bullish pennant is a technical chart pattern that signals a continuation of a strong uptrend after a brief period of consolidation. The pattern resembles a small symmetrical triangle, formed after a significant price movement, known as the flagpole. In the first half of 2020, Tesla's stock price experienced a remarkable increase, driven by strong demand for its electric vehicles, improved production capacity, and better-than-expected financial results. In June 2020, the stock price started consolidating, forming a symmetrical triangle pattern that lasted for about a month. This consolidation period represented the bullish pennant, with investors anticipating a breakout and a continuation of the upward trend. In early July, the price broke out of the pennant, and Tesla's stock continued its rapid ascent, reaching new all-time highs by the end of August 2020. This example showcases the characteristics of a bullish pennant pattern: a strong initial price movement, the flagpole, a period of consolidation, the pennant, and a continuation of the uptrend following the breakout. To verify this example, you can refer to historical stock price data from sources like Yahoo Finance or Google Finance. Reference the case study link for a view of Tesla's historical data page on Yahoo Finance. Adjust the date range to include June to July 2020 to view the specific chart pattern mentioned in this example. A well-regarded book on technical analysis that covers the bullish pennant, among other chart patterns, is Encyclopedia of Chart Patterns, by Thomas N. Bulkowski. This comprehensive reference book provides an in-depth study of numerous chart patterns with detailed information on their identification, trading techniques, and performance statistics. The author presents real-world examples, performance rankings, and statistical research to help traders understand the practical implications of using chart patterns in their trading strategies. The book is well organized and easy to understand, making it a valuable resource for traders of all experience levels who want to enhance their knowledge of chart patterns and technical analysis. This book provides an extensive overview of various chart patterns, their performance statistics, and trading tactics. Reading this book can help you gain a better understanding of the bullish pennant and how to incorporate it into your trading strategy. An inverse head and shoulders is a chart pattern in technical analysis that signals a potential bullish reversal, indicating the end of a downtrend and the beginning of an uptrend. It is named as such because it resembles an upside-down head and shoulders pattern when viewed on a price chart. The pattern consists of three key components: the left shoulder, the head, and the right shoulder. Here's a simple explanation of its components. Left shoulder. The left shoulder forms when the price declines to a low point and then rebounds, creating a trough. Head. The head is the central and lowest part of the pattern. It forms when the price declines even further, reaching a lower low than the left shoulder, and then rebounds. Right shoulder. The right shoulder forms when the price declines again but not as low as the head, creating a higher low. Afterward, the price rebounds, marking the completion of the right shoulder. In addition to these components, the inverse head and shoulders pattern also features a neckline, which serves as a resistance level. The neckline is a trend line drawn by connecting the peaks between the shoulders. To trade an inverse head and shoulders pattern, traders typically wait for a breakout above the neckline, which signals a bullish reversal. They may enter a long position when the price breaks above the neckline, with a stop-loss order placed below the lowest point of the head to manage risk. The price target for the trade is often calculated by measuring the distance between the head and the neckline and projecting that distance upward from the breakout point. The inverse head and shoulders pattern has been recognized and studied since the early 20th century. A famous example of the inverse head and shoulders pattern can be observed in the chart of the S&P 500 index during the period of the global financial crisis in 2008-2009. To better understand this example, let's break it down into key events. Downtrend. The S&P 500 entered a significant downtrend starting in late 2007, as the U.S. housing bubble burst and the global economy faced a severe financial crisis. Formation of the pattern. The inverse head and shoulders pattern began to form in late 2008. The left shoulder was formed in October 2008, when the S&P 500 reached a low of around 840 points. The head was formed in March 2009, with the index bottoming out at approximately 667 points. Finally, the right shoulder was formed in July 2009, with a low of around 869 points. Reversal and breakout. In September 2009, the S&P 500 broke above the neckline, the resistance level that connects the peaks between the shoulders and the head, signaling the completion of the inverse head and shoulders pattern and the beginning of a new uptrend. New uptrend. The breakout marked the end of the downtrend, and the S&P 500 entered a sustained uptrend that would continue for several years, eventually leading to new all-time highs. To verify this example, you can refer to historical price data of the S&P 500 index from sources like Yahoo Finance, Google Finance, or FRED, which stands for Federal Reserve Economic Data. See case study reference. Adjust the date range to include 2007 to 2009 to view the specific chart pattern mentioned in this example. A well-regarded book on technical analysis that covers the inverse head and shoulders, among other chart patterns, is Technical Analysis of Stock Trends, by Robert D. Edwards and John McGee. This book is considered a classic in the field of technical analysis and provides a comprehensive introduction to chart patterns, indicators, and trading strategies. Reading this book can help you gain a better understanding of the inverse head and shoulders and how to incorporate it into your trading strategy. A triple bottom is a chart pattern in technical analysis that signals a potential bullish reversal, indicating the end of a downtrend and the beginning of an uptrend. The pattern is named triple bottom because it features three distinct troughs or low points, all occurring at roughly the same price level. When viewed on a price chart, it resembles the shape of a W. Here's a simple explanation of its components. First bottom. The price declines to a low point and then rebounds, forming the first bottom or trough. Second bottom. The price declines again, reaching a low point approximately at the same level as the first bottom, and then rebounds. Third bottom. The price declines for the third time, reaching another low point at a similar level to the previous bottoms, and then rebounds. In addition to the three bottoms, the triple bottom pattern also features a resistance level, which serves as an important price point for the pattern's confirmation. The resistance level is a horizontal line connecting the peaks between the troughs. To trade a triple bottom pattern, traders typically wait for a breakout above the resistance level, which signals a bullish reversal. They may enter a long position, buy, when the price breaks above the resistance level, with a stop-loss order placed below the lowest point of the three bottoms to manage risk. The price target for the trade is often calculated by measuring the distance between the resistance level and the lowest point of the bottoms, then projecting that distance upward from the breakout point. In summary, a triple bottom is a chart pattern that indicates a potential bullish reversal after a downtrend. It is characterized by three distinct troughs, all occurring at roughly the same price level, and a horizontal resistance level connecting the peaks between the troughs. Traders use this pattern to identify potential buying opportunities when the price breaks out above the resistance level. A good book to learn about triple bottom trading pattern and other chart patterns is Japanese Candlestick Charting Techniques, by Steve Nissen. This book delves into the world of candlestick charting, which is a popular method of technical analysis that originated in Japan. While the primary focus of the book is on candlestick patterns, it also covers various classic chart patterns, including the triple bottom, and explains how to combine candlestick analysis with these patterns for more effective trading decisions. Nissen's book is comprehensive and easy to understand, making it a valuable resource for traders who want to learn more about candlestick charting and its application in conjunction with other chart patterns. This book is suitable for both beginners and experienced traders who want to enhance their knowledge of technical analysis and explore the benefits of using Japanese candlestick charting techniques in their trading strategies.
Here's a simple explanation of its components. First bottom. The price declines to a low point and then rebounds, forming the first bottom or trough. Second bottom. The price declines again, reaching a low point approximately at the same level as the first bottom, and then rebounds. In addition to the two bottoms, the double bottom pattern also features a resistance level, which serves as an important price point for the pattern's confirmation. The resistance level is a horizontal line connecting the peaks between the troughs. To trade a double bottom pattern, traders typically wait for a breakout above the resistance level, which signals a bullish reversal. They may enter a long position, buy, when the price breaks above the resistance level, with a stop-loss order placed below the lowest point of the two bottoms to manage risk. The price target for the trade is often calculated by measuring the distance between the resistance level and the lowest point of the bottoms, then projecting that distance upward from the breakout point. In summary, a double bottom is a chart pattern that indicates a potential bullish reversal after a downtrend. It is characterized by two distinct troughs, both occurring at roughly the same price level, and a horizontal resistance level connecting the peaks between the troughs. Traders use this pattern to identify potential buying opportunities when the price breaks out above the resistance level. Here's a true story about the double bottom pattern, along with an open source reference. In 2016, semiconductor manufacturer Advanced Micro Devices, AMD, experienced a significant decline in its stock price due to concerns about the company's financial performance and market share. The stock dropped from a high of around $15 in 2015 to a low of around $1.60 by early 2016. However, in early 2016, AMD's stock formed a double bottom pattern, with two distinct troughs occurring at roughly the same price level. The first bottom formed in January, followed by a rebound, and then a second bottom formed in February. The bottoms were well defined and indicated strong support. Traders and investors recognized the double bottom pattern in AMD's stock and saw it as a potential buying opportunity. They started accumulating shares, expecting a potential bullish reversal. As the pattern played out, the stock broke above the resistance level formed by the peak between the two bottoms, confirming the pattern's completion. AMD's stock subsequently experienced a significant rally, reaching new highs over the next few years. The company benefited from successful product launches and market expansion, leading to increased investor confidence and a positive turnaround in its financial performance. This story is referenced in an open-source article on Investopedia titled, Double Bottom Pattern. The article explains the double bottom pattern, its characteristics, and how traders can identify and trade this pattern effectively. It also includes a chart illustrating AMD's double bottom formation. An informative book to learn about the double bottom trading pattern and other chart patterns is Charting and Technical Analysis by Fred McCallan. This book offers a comprehensive introduction to chart patterns, technical indicators, and various trading strategies that incorporate technical analysis. In this book, McCallan covers a range of chart patterns, including the double bottom, and provides practical guidance on identifying and trading these patterns effectively. The book is written in an easy-to-understand language and includes numerous real-world examples and illustrations, making it suitable for both beginners and experienced traders who want to enhance their knowledge of technical analysis and chart patterns. Charting and technical analysis serves as an excellent foundation for those looking to explore the world of chart patterns and technical analysis and apply these concepts to their trading strategies.
A falling wedge is a chart pattern in technical analysis that signals a potential bullish reversal, indicating the end of a downtrend and the beginning of an uptrend. This pattern can also appear during an uptrend, acting as a bullish continuation pattern. The falling wedge is characterized by converging trend lines that slope downward, forming a narrowing wedge shape as the price moves within these lines. Here's a simple explanation of its components. Upper trend line. The upper trend line is formed by connecting the lower highs of the price, showing a downward slope. Lower trend line. The lower trend line is formed by connecting the lower lows of the price, also sloping downward but at a less steep angle than the upper trend line. Converging trend lines. The falling wedge pattern is created when both the upper and lower trend lines converge as they extend, reflecting a decrease in selling pressure and potentially leading to a bullish reversal. To trade a falling wedge pattern, traders typically wait for a breakout above the upper trend line, which signals the bullish reversal or continuation. They may enter a long position, buy, when the price breaks above the upper trend line, with a stop-loss order placed below the most recent low to manage risk. The price target for the trade is often calculated by measuring the distance between the highest and lowest points within the wedge, then projecting that distance upward from the breakout point. In summary, a falling wedge is a chart pattern that indicates a potential bullish reversal or continuation, characterized by converging downward sloping trend lines that form a narrowing wedge shape. Traders use this pattern to identify potential buying opportunities when the price breaks out above the upper trend line. A good book that discusses the falling wedge trading pattern, along with other chart patterns and technical analysis concepts, is Trading for a Living, Psychology, Trading Tactics, Money Management, by Dr. Alexander Elder. This book is an excellent resource for both beginners and experienced traders who want to learn more about technical analysis and chart patterns. Dr. Elder provides a well-rounded approach to trading, covering various aspects such as psychology, trading tactics, and money management. While this book may not exclusively focus on the falling wedge pattern, it offers valuable insights into how to identify and trade chart patterns effectively, helping traders develop a solid foundation in technical analysis. A cup with handle is a bullish chart pattern in technical analysis that signals a potential continuation or reversal, indicating the end of a consolidation phase and the beginning of an uptrend. The pattern resembles a teacup with a handle on its right side when viewed on a price chart, which is how it gets its name. Here's a simple explanation of its components. Cup. The cup forms when the price undergoes a rounded bottom, with the price first declining and then gradually recovering to reach the same level as the start of the decline. The bottom of the cup should be U-shaped, not V-shaped. Handle. The handle forms as a consolidation or a slight downward retracement in price after the cup. It typically takes the shape of a small trading range, channel, or a flag pattern. The handle should not retrace more than 1/3 of the cup's depth. Breakout. The breakout occurs when the price moves above the resistance level formed by the top of the cup or the upper trend line of the handle. This breakout signals the bullish continuation or reversal and serves as the entry point for traders. To trade a cup with handle pattern, traders usually wait for the breakout above the resistance level. They may enter a long position, buy, when the price breaks above this level, with a stop-loss order placed below the lowest point of the handle to manage risk. The price target for the trade is often calculated by measuring the distance between the bottom of the cup and the resistance level, then projecting that distance upward from the breakout point. In summary, a cup with handle is a chart pattern that indicates a potential bullish continuation or reversal, characterized by a rounded bottom followed by a consolidation phase. Traders use this pattern to identify potential buying opportunities when the price breaks out above the resistance level formed by the top of the cup or the upper trend line of the handle. A hypothetical and anecdotal trading story involving the cup with handle could be as follows. In the late 2010s, a trader named Mark was closely monitoring a stock in the renewable energy industry that had been on a strong upward trend due to growing consumer interest in clean energy solutions. He noticed that the stock had formed a cup with handle pattern, with the price retracing and forming a rounded cup shape before consolidating into a smaller handle. Mark decided to keep an eye on the stock and set a buy order slightly above the resistance level formed by the top of the handle, anticipating a breakout to the upside. Eventually, the stock broke through the resistance level and experienced a significant increase in price. Mark's long position allowed him to profit from the continued uptrend. A well-regarded book on technical analysis that covers the cup with handle, among other chart patterns, is How to Make Money in Stocks: A Winning System in Good Times and Bad, by William J. O'Neill. This book provides a comprehensive overview of O'Neill's trading strategies, including the Can Slim system, which incorporates the cup with handle pattern. Reading this book can help you gain a better understanding of the cup with handle and how to incorporate it into your trading strategy. A bullish rectangle is a chart pattern in technical analysis that signals a potential continuation of an existing uptrend. The pattern forms when the price consolidates in a sideways trading range, bound by parallel horizontal support and resistance levels, before breaking out and continuing the uptrend. The bullish rectangle is also known as a trading range or consolidation pattern. Here's a simple explanation of its components. Uptrend. The bullish rectangle forms during an existing uptrend. The price experiences a period of consolidation after a strong upward move. Support and resistance. The pattern is characterized by a well-defined support level, where the price stops falling, and a resistance level, where the price stops rising. These levels are roughly horizontal and parallel to each other, giving the pattern a rectangular shape. Consolidation. Within the rectangle, the price moves sideways, bouncing between the support and resistance levels, as the market participants take a pause before deciding on the next move. Breakout. The breakout occurs when the price moves above the resistance level, signaling a continuation of the uptrend. This breakout serves as an entry point for traders who anticipate a further rise in the price. To trade a bullish rectangle pattern, traders typically wait for the breakout above the resistance level. They may enter a long position when the price breaks above this level, with a stop-loss order placed below the support level to manage risk. The price target for the trade is often calculated by measuring the distance between the support and resistance levels, then projecting that distance upward from the breakout point. In summary, a bullish rectangle is a chart pattern that indicates a potential continuation of an existing uptrend, characterized by a sideways consolidation within parallel horizontal support and resistance levels. Traders use this pattern to identify potential buying opportunities when the price breaks out above the resistance level, signaling a continuation of the uptrend. A hypothetical and anecdotal trading story involving the bullish rectangle could be as follows. In the late 2010s, a trader named Emily was closely monitoring a stock in the electric vehicle industry that had been on a strong upward trend due to growing consumer interest in electric cars. She noticed that the stock had formed a bullish rectangle pattern, with the price consolidating within the rectangular channel between the support and resistance levels. Emily decided to keep an eye on the stock and set a buy order slightly above the resistance level, anticipating a breakout to the upside. Eventually, the stock broke through the resistance level and experienced a significant increase in price. Emily's long position allowed her to profit from the continued uptrend. A good book that covers the bullish rectangle trading pattern, along with various other chart patterns and technical analysis concepts, is Technical Analysis Using Multiple Timeframes by Brian Shannon. In this book, Shannon discusses the importance of using multiple timeframes in technical analysis and provides a detailed explanation of various chart patterns, including the bullish rectangle. He also explains how to identify potential trading opportunities using multiple timeframes and offers insights into developing a robust trading strategy. The book provides a practical approach to technical analysis and is suitable for traders of all levels, from beginners to advanced traders. By studying technical analysis using multiple timeframes, you'll gain a deeper understanding of the bullish rectangle pattern and learn how to integrate it into your trading strategy using multiple timeframes. The bullish symmetrical triangle is a chart pattern in technical analysis that forms during an uptrend and is considered a continuation pattern. It is characterized by two converging trend lines that connect a series of lower highs and higher lows, forming a shape like a triangle. The pattern typically indicates that the price is consolidating before a breakout to the upside, signaling a continuation of the prevailing bullish trend. The bullish symmetrical triangle has been recognized and studied since the early 20th century, particularly by pioneers of technical analysis such as Richard Schabacker and Edwards and McGee. An anecdotal trading story involving the bullish symmetrical triangle could be as follows. In the late 1990s, a trader named Jane was following the tech boom and had her eyes on a particular stock that had been on a strong upward trend. She noticed that the stock had formed a bullish symmetrical triangle, with the price consolidating within the converging trend lines. Jane decided to keep a close watch on the stock and set a buy order slightly above the upper trend line, in anticipation of a breakout. Eventually, the stock broke through the resistance and experienced a sharp increase in price. Jane was able to ride the uptrend, selling her position at a higher price and making a profit. A well-regarded book on technical analysis that covers the bullish symmetrical triangle, among other chart patterns, is Technical Analysis of the Financial Markets, by John J. Murphy. This book provides a comprehensive introduction to technical analysis and offers insights into various chart patterns, indicators, and trading strategies. Reading this book can help you gain a better understanding of the bullish symmetrical triangle and how to incorporate it into your trading strategy. Important disclaimer. This video and its content, is for entertainment purposes only. Absolutely no qualified, accredited, or professional investment and financial advice, information, data, research, product, service, education, recommendation or otherwise, are presented, marketed, or offered in this video. Additionally, no warranty, guarantee, assurance, or factual assertions are offered or stated in this video. Never use this video to influence or determine investment or financial decisions. Consult a qualified licensed professional for your investment and financial needs. Do so away from TickerDD and YouTube. Remember that investments are risky, whereby capital losses can occur in full or in excess. TickerDD, an in-progress framework of nerdy data science and robotics stuff, auto-generated this video strictly for entertainment purposes, as part of an in-progress exercise by a group of novices who wants to discover and learn about specific facets of the market, through trial and error. This group of novices are not licensed, accredited, or qualified financial or investment professionals. This video is only material for entertainment purposes. This generated video, like all videos uploaded dynamically by TickerDD, is only for this group of novices' private usage even if videos are uploaded publicly. Importantly, TickerDD is not about stocks but is specifically about the discovery, through trial and error, of technologies and data that govern opinionated observational data models as this group of novices builds them quickly and iteratively as part of learning and in-progress machine training. This video wholly contains opinions and commentaries, even if they were auto-generated. Remember that bots, data models, data, and methods may include hidden assumptions, undefined and unrefined variables, as well as errors and unfit approaches, all of which can and will exist in this very video. Your access, view, and share of this video constitute your acknowledged agreement to this important disclaimer and that, specifically, this video is for your entertainment purposes only, whereby you will not take actions or make decisions off it, concerning your finances and investments. As such, you grant full release of claims, directly or indirectly, from your access, view, and share of this video, against TickerDD and its affiliates. The people and entities, affiliated to the ticker that is covered in this video, are not affiliated with this opinionated video and do not endorse this video.